So a lot of new traders think that picking out a strike price is a big deal, when in reality it's very simple if you stick to a couple strict rules that I personally use. It's not a big concept. The way I look at it is that there's no right strike price to pick, but there is a wrong strike price to pick. And you're going to understand that when I explain it into a little more detail in this video. But you don't want to pick a wrong strike price and be right on the underlying stock's direction. You know, if you're buying calls and you expect, let's say, Netflix to go up in price, you don't want to buy the wrong strike contracts and lose money on the trade even though you're right on the underlying direction. But because you bought the wrong strike, you're going to lose money on that trade because your contracts that you bought were not the proper ones to the plan that you were looking to execute. So that's the first rule, is that there's no right contract that you could choose, but there is a wrong contract. And the second rule is that you have to, before you enter the trade, you have to understand what type of trade you're looking to put on. Are you looking to day trade? Are you looking to swing trade? Are you looking to scalp? And in this video, we're going to cover scalping and day trading. But you have to have an idea of what type of trade you're looking to put on, because you have to, before you enter the trade, know where your profit target is going to be. So, let's say you buy calls at $400 and your profit target, you have to say, is at $410. And you have to know where your entry is going to be at and your stop loss and your profit target area, because that's going to determine what type of strike you're going to pick for day trading. With scalping, that's going to be towards the end of this video. It's very simple how I pick my strike prices for when I'm scalping only. But those are the two rules I just want you guys to understand before we get into what I look for when I'm day trading, because I know a lot of the people that watch this video are pretty much going to be either day trading or scalping options plays. So let's get into the first one, which is what I look for and the criteria that I look for when I'm day trading options. So what I look for when I'm day trading options is two things. I look for liquidity, is the number one thing I look for. So what I mean by liquidity is that the option contracts, I'm going to either be able to buy and sell, exit or enter my position without having a problem. And because of that is the spreads are going to be tight. If you trade options or even stocks with low liquidity, your bid and ask, the spread between the two, are going to be wide, and it's going to be hard for you to enter and exit that trade because of the spreads being so wide. So for these option contracts, I look for liquidity. And the two things I look for to see if the option contracts are liquid is volume and open interest. So you could get that from this layout tab, and you could open volume and open interest. What volume is telling me is that how many option contracts have traded so far today. So the first one where my cursor is, the at the money 445 strike calls, there were 6,500 contracts that traded today, and open interest is telling me how many contracts are pretty much used as open positions. 1,820 contracts right now are open that some investors or traders have currently in their position, versus an illiquid option, which in this case we're way in the money. Just to illustrate this, these 250 strike calls have a volume of 12, so they traded 12 contracts today, and an open interest of 29 contracts, so 29 open contracts for these strike calls that people currently own. So you have to look for liquidity. It's going to be much simpler when you have liquidity. It's not going to be a headache because the spreads are going to be tight. And then the second thing is that you have to look for delta. Now, what I look for with delta is that at least a 0.30 on the call and put side. The puts are going to be negative and the calls are going to be positive, but they have to be a delta of 0.30 or greater. And what that tells me is that for every dollar that the underlying stock moves, so in this case we have Netflix, for every dollar that Netflix moves up, my calls are going to go up. My premiums on the contracts are going to go up by whatever the delta is for every dollar the stock moves up. And of course, you have to factor in other option Greeks, but that is just the delta, and it's going to give you a good estimate of where your contracts are going to be based on the underlying stock's movement. So deltas of at least 0.30 is what I look for. And usually you're going to find for names like Netflix, Apple, Facebook, you're usually going to find 0.30 deltas either at the money or one out of the money. I don't really play in the money for when I'm day trading because obviously my profit target is going to be out of the money. So I want my contracts that I'm buying at the money or out of the money to become close to in the money, because what happens is then the deltas are going to go up, the premiums are going to go up, and as the stock gets closer, as my contracts get closer to becoming in the money, the greater percent return I'm going to get on my contracts. So you can never go wrong when you're day trading playing one at the money or one out of the money. Now, if you trade names like Amazon, Google, names that have big ATRs that move in a range such as, 50, 60 points in a day, you could play 3 out of the money, 4 out of the money, 5 out of the money, because look, 5 out of the money, the deltas are 0.33. So 33 on the deltas if you go 5 out of the money. Even 6 out of the money, you're close to 0.30. So it all depends on the stock you're playing, but you want to either A, have liquidity, and B, have a delta of 0.30, and usually you're going to get that by playing at the money or 1 out of the money, some cases 2 out of the money, but I really never play in the money for when I'm day trading. So we have an example here. We have Netflix, which rallied into supply. We had a supply imbalance, and I'm looking to grab puts based off of the first rejection, and then the second rejection, we double topped in supply. I'm looking to short at supply and take profits at 440, which is demand. So this goes into the second thing, is you have to have a profit target, an area where you're going to look to take profits and exit your trade. If you're right, you have to have a good understanding where that area is going to be, and that's going to be all predetermined before you enter the trade. So obviously I'm looking to, cover my position or, exit my call positions in demand, and this is in the 440 area. So at the time these contracts were here at 443, these 440s are at the money. I'm talking about puts because I'm capitalizing on a bearish position. So I'm going to copy my Netflix 440 puts, which are at the money, in here. I'm going to go to a 5-minute chart, and I'm going to copy my 435s, which are 1 out of the money, into my right chart. So if we were to short, I have my crosshairs synced, so you're going to see my crosshairs synced up with each chart. If we were to short at my yellow circle right here on Netflix, the underlying stock, the option contracts for at the money, or the 440 puts, which are on their left screen, went from 620 to 830, a whole $2, and they went up by 34.3%. So I rounded it up to 35%. That is at the money. Now, if you go out of the money by 1, these are the 435 strikes. If you go out of the money by 1, these went from 430 to 590, which also was a 35.5% return. So they both yield about the same results at the money and 1 out of the money. That's why you can never go wrong if you're day trading with a close profit target, playing at the money or 1 out of the money. But watch what happens if we go further out of the money. So let's say the 390s. Let's say we have an account with $500 and we're going to buy 10 contracts of the 390 strike puts. I'm going to copy these into my option chart. So again, at the same price that we shorted or we longed the puts, I'm going to draw my trend line and see the percent return that we're going to get if we covered in demand. And this is also 31%. So these are like 10 out of the money, and they yielded me 32%, which isn't bad, right? But the contracts only moved from 26 cents to 32 cents. So they went up about 6 or 7 cents. 26 cents to 32 cents. It's still a high percentage, but the contracts did not move up that much. And look at that. That's because the deltas are very low. The deltas in this case are 0.02. I look for 0.30. Another thing you have to understand is that as the out of the money contracts start moving in your favor and start becoming closer and closer to in the money, they are going to increase in percent wise by a lot. And that is because B, the deltas are going to increase the closer you get to in the money. As soon as, look how the closer we get into the money, look at the deltas as they go up in price. So if you're day trading with a profit target, let's say, at the 430 mark, the 435 mark, you can play out of the money. You can play one out. You can play at the money still. It's still going to make you money. But if you play way out of the money, and let's say on a Friday, and the stock does not move in your favor, those contracts, everything out of the money is going to be worthless, and it's going to be worth zero. So that's what I do for day trading. And that's why there's no really right way to play the contracts, because as you guys can see, you could play the 440s, the 435s, the 430s. They would have made you money. But if you played way out of the money, which was the wrong thing to do, you wouldn't have been able to capitalize on a decent dollar amount on the contracts, even though you yielded a decent percent amount on the contracts. So you can never go wrong playing one at the money or one out of the money. So now I jumped into on demand, and I'm going to show you what I look for when I scalp option contracts and the right strike price I use personally when I scalp. So this is Netflix. We had a nice rally to the upside. Then all of a sudden we based out. The price started to look attractive to the downside. And what you have here is you have retail traders selling, providing liquidity for big institutional traders to get filled for another leg to the upside that missed their first move here when they rallied and missed their orders here. So also we have 424, which is the key level of yesterday that we rejected. And now today we're coming up, retesting this level. So I'm looking to scalp calls over the 424 level if we get above. So what I do is I make sure I have my time and sales up, I have my level 2 up, and I'm watching 424 on the ask to show not aggressive sellers, less size on the ask size, and I want to see 424 prints come through on the time and sales. But now I want to make sure I have my option contract ready to go. And what I look for with scalping options is I look for at the money or one in the money for scalping options. These are fast moves. I'm looking to get in and out very fast. My entries are fast. My exits are even faster. So I'm not looking to hold for a 10-point rip to the upside. I'm not looking to hold for 30 minutes, an hour, 2 hours. I'm looking to get in and out fast. And because of that, I'm playing at the money or one in the money. And I could say about 80%, 85% of the time, I'm looking to see which ones have better liquidity. And most of the time, it's the ones at the money. So I'm copying my at the money contracts into my active trader setup. If you have not seen my active trader video, go watch that video. This is a good tool to scalp options. I'll link that below. So now really what I'm doing is I'm watching this 424 level. I have my finger on the market order because I have liquidity on these contracts. So I know my spreads are going to be tight. In this case, we're on demand, so the data is a little skewed. As you can see, we don't even have the deltas up here. But I know in real time, these spreads are going to be pretty much tight. So it's acceptable to market order on tight spreads. But anyway, I have my contracts loaded into my active trader. I'm watching for 424 prints come up on the time and sales. I'm watching for not aggressive sellers on the ask. I'm watching for heavy buyers on the bid. And I have my at the money contracts loaded into my active trader. You could have in the money. But like I said, I'm waiting for 424 to break to the upside. As soon as I see prints come through, I'm market ordering in because my spread is tight. Now I'm in, I'm going to hold this for whatever. We have supply at 426 area. So I'm going to be looking, maybe my profit target's at 426. This is different than how we were to day trade them. I'm not playing out of the money contracts for scalping. I'm not playing one out of the money. The farthest I'm going to go is at the money. So now that we, capitalized on a quick move to the upside, you can either sell, scale out half, whatever. But, we're up $525 on 10 contracts for this quick move to the upside. Like I said, the data is a little skewed, but anyway, you get the point. At the money, one in the money. I know I keep repeating myself, but I don't want you guys playing way out of the money contracts for scalping and your contracts not go up at all because you played way out of the money and you're capitalizing just on a quick little move up or down. So I hope you guys enjoyed this video. If you guys learned anything, please subscribe, please drop a like and comment if you have any questions or any suggestions for my next videos.